Imagine you're running a business
Right.
and you are just acing every single one of your quarterly
Yeah,
targets.
right.
You're beating all of Wall Street's expectations. And as a reward, the market slashes your company's value nearly in half.
It's brutal. Just absolutely brutal.
It is. And that is the exact paradox we're currently seeing with Chewy, the massive online pet retailer.
Oh, yeah.
So today, for those of you joining us, welcome to the deep dive. We have a huge stack of equity research and financial data to unpack for you today.
We really do. There is a lot to get through.
And our mission today is to essentially look under the hood of this massive disconnect. We are going to find out how a beloved company beats its Q1 earnings, yet somehow finds its stock trading down, I think it was 48% from its 52-week high.
Yeah, almost 50% wiped out.
Exactly. We want to figure out for you if this is, a structural failure of their business model, maybe just a macroeconomic blip, or, and this is the exciting part, a potential contrarian opportunity for the market.
I mean, it is the ultimate case study in how financial markets actually process information.
Right.
Because the situation with Chewy perfectly illustrates that the stock market is not a report card. It's not grading past performance.
Right. It doesn't care what you did yesterday.
Exactly. It is this relentlessly forward-looking mechanism. It's constantly obsessing over what a company will do tomorrow, next year, a decade from now.
So let's start by laying out those immediate financial facts from their fiscal Q1 2026, which ended May 3, 2026.
Let's do it.
Because on paper, looking at this snapshot, Chewy just totally crushed it.
They really did.
They reported net sales of $3.36 billion. That's up 7.7% year over year.
Which is solid growth for their scale.
Very solid. And it wasn't just top-line revenue either. Their profitability metrics looked highly impressive in isolation. Net income was $94.8 million.
And just for context, that is a massive jump from the $62.4 million they did in the prior year quarter.
Right, a huge leap.
And the earnings per share, or EPS, came in at 43 cents. That beat the consensus estimates comfortably. We also saw their gross margins expand.
Yeah, the report highlights that their adjusted EBITDA rose over 31% to $253.1 million.
That's a big number.
It is. And for those of you listening who might not spend your days staring at financial statements, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
A very long acronym.
Right, exactly. But it's essentially just a way to look at a company's raw operating cash flow before all the accountants and tax codes get involved.
Yeah, it shows the core business health.
And the adjusted part just means they stripped out, one-time irregular expenses to give a clearer picture of their day-to-day money-making ability.
Which makes that 31% growth metric fantastic.
Right. If you look at just those 3 months, the engine is humming, you're popping the champagne.
You would think so, yeah.
But the market reaction was just brutal. So why? Why isn't the market rewarding this influx of positive data? It feels like getting an A on your midterm, but the teacher immediately tells you you're still projected to fail the class.
That is a great analogy. And the answer really lies entirely in the concept of the growth narrative.
Okay, unpack that a bit.
So in the stock market, particularly for e-commerce companies that historically traded at these massive premiums during their, rapid expansion phases, past performance is merely a footnote.
Right.
The stock price today is basically a discounted mechanism of all expected future cash flows. And for Chewy, that growth narrative fundamentally broke during this exact same earnings call.
Oh, because management actually changed the trajectory of the future right there on the call.
Precisely.
Looking at the guidance they issued, management lowered their full-year fiscal 2026 sales projections. They originally told Wall Street to expect between $13.60 and $13.75 billion.
Yeah.
And they slashed that down to a range of $13.4 to $13.55 billion. That entire new range sits below the consensus estimate of roughly $13.65 billion that the analysts had modeled.
And the Q2 sales guidance suffered the exact same fate.
Really?
Yeah, coming in at $3.3 to $3.33 billion, with adjusted EPS around 36 cents. Both of those figures just flat out disappointed Wall Street.
Right.
But, the actual mathematical downgrade wasn't even the deepest cut. No, the real damage was the qualitative commentary from the executive team.
Oh, right. The quote from the transcript is striking. Management explicitly stated that it is, quote, no longer prudent to assume a meaningful acceleration in consumer spending.
Yeah. That single sentence right there.
That's a heavy sentence.
It forces every financial analyst covering the stock to rewrite their long-term models. I mean, when a management team essentially waves a white flag on consumer acceleration, they are signaling that macroeconomic headwinds are just too strong.
Things like inflation and tightening household budgets, you mean?
Exactly. Too strong for them to outmaneuver. So analysts have to take their optimistic, upward-sloping growth curves, literally erase them and draw flatter, much more sobering lines.
And that just erases billions of dollars in projected future value in an instant.
In a fraction of a second.
So management isn't just tweaking a spreadsheet here. They're reacting to a real behavioral shift on the ground.
Absolutely. You can see the exact moment consumers started pulling back when you look at Chewy's active user metrics.
Right, let's look at those. Their total active customers reached 21.5 million. Which is technically up 3.6% year over year.
Technically up, sure.
But the underlying momentum is stalling out. The quarterly net additions, meaning, the new customers they are bringing in minus the old ones leaving the platform, are sitting at roughly 200,000.
And that 200,000 figure is lingering near the very bottom of their target range.
Which is what, 150 to 250,000?
Exactly, 150 to 250,000 net additions per quarter. But honestly, the more troubling signal comes from a metric called net sales per active customer, or NSPAC.
NSPAC, right. It increased slightly to $597, but the growth rate of that metric is decelerating dramatically.
It is. This really signals the end of the premiumization trend.
Premiumization, yeah, because during the pandemic, we treated our dogs and cats like absolute royalty.
We really did.
We bought the organic, grain-free kibble, the memory foam dog beds, the artisanal treats.
The little doggy sweater.
Exactly. All of that premiumization drove up the amount every active customer spent.
Whoa.
But with inflation and elevated fuel prices just pinching household budgets, that trend is reversing.
Yeah, we are seeing a hard pivot back to basics. People are just buying what they need. However, you could argue that Chewy has a built-in defense mechanism against this exact consumer pullback.
Well, you're talking about the auto-ship moat.
Yes.
The report highlights that their auto-ship subscription model accounts for a staggering 84.4% of total net sales.
Which is huge.
And that specific segment is actually growing at 10.5% year over year, which is outpacing the rest of the business.
Right.
If you have 84% of your revenue locked into a sticky recurring subscription model, you would assume the company is practically bulletproof in an economic downturn.
You would assume that, yeah. Autoship is undeniably a brilliant defensive floor. It keeps the revenue from falling off a cliff, which is why the business itself is not structurally failing.
Right, they aren't going bankrupt.
Exactly. But that 84% number hides a critical vulnerability. When you look at what is actually inside those autoship boxes, you expose the flaw in the growth thesis.
What do you mean?
Well, subscribers are keeping their essential 40-pound bags of standard dog food coming every month, but what they are cutting out are the discretionary high-margin items. The extra squeaky toys, the luxury pet apparel, the fancy treats.
So they keep the kibble, but they ditch the toys.
Exactly. And that shift is devastating for profitability. The necessities have razor-thin margins.
Oh, because shipping heavy, bulky bags of dog food across the country has to be incredibly expensive from a logistics standpoint.
Extremely expensive. Chewy basically relied on throwing a high-margin squeaky toy into that same box to make the overall delivery highly profitable.
And without the toy, the margin shrinks.
It vanishes. And this dynamic forces Chewy into a direct collision course with their biggest structural disadvantage.
Which brings us to the elephant in the room. Amazon.
Amazon.
Because Amazon operates in a completely different paradigm than a standalone retailer.
Absolutely. When you analyze the raw financial mechanics here, Chewy's trailing 12-month net margin is a microscopic 1.99%.
Less than 2%.
Yeah. Amazon, conversely, operates like a subsidized toll road. They have a vastly superior logistics network, unmatched economies of scale, and most importantly, they generate massive profits from their other business segments.
Like Amazon Web Services.
Exactly.
AWS.
So Amazon can afford to take a loss shipping a heavy bag of dog food because they are making billions hosting cloud servers. Right. They use the dog food as a loss leader just to keep you locked inside their prime ecosystem.
While Chewy has no such subsidy, they actually have to make money selling the pet food.
Exactly. So if the pet category is structurally maturing and consumers are hunting for the absolute lowest price on basic staples, Chewy is forced into a price war with an apex predator.
An apex predator that can bleed cash on retail indefinitely.
Yep. That squeeze between a tightening consumer abandoning high-margin items on one side and an apex competitor dominating the low-margin staples on the other is terrifying for investors.
Right.
It completely explains how the market is repricing the risk associated with this stock.
And the numbers on that repricing are just brutal. Based on the data in the report we have for you today, Chewy is trading at $22.59, which is down almost 4% just on the day this report was issued.
Wow.
If you zoom out, it is 48.1% below its September 2025 high of 43.5. The stock has basically been cut in half, sitting only modestly above its June 2026 low of 17.40.
And the analyst community is aggressively slashing their targets, too.
Yeah, Morgan Stanley cut their target, Bank of America cut theirs. Piper Sandler literally took an axe to their model, dropping their price target all the way from $48 down to $30.
That's a massive haircut.
MoffettNathanson downgraded the stock entirely from a buy to a neutral rating.
You know, an aggressive cut like the one from Piper Sandler isn't just a minor spreadsheet adjustment.
What does it signal?
It signals a fundamental reset in how Wall Street values the entire trajectory of the company. It indicates that analysts no longer believe the old growth story is coming back anytime soon.
Well, while the analysts are running for the hills, the research points out another major red flag: insider selling.
Oh, yeah.
Over the last 90 days, there have been 12 insider sells versus only 6 buys.
That never looks good.
No. And the most prominent transaction was the CEO recently selling 81,841 shares for $1.9 million.
Which is a big headline number.
To a retail investor, this looks terrible. Is leadership quietly abandoning ship while going on earnings calls and telling the public that the auto ship moat is strong?
It is so easy to look at a cluster of insider selling during a stock slide and just assume the absolute worst. But the mechanics of these transactions actually provide some really crucial nuance.
Okay, lay it on us.
The CEO's sale of those 81,000 plus shares was actually executed under a prearranged 10b5-1 plan.
Okay, let's unpack how those plans actually work, because they are vital to understanding corporate behavior. A 10b5-1 plan is essentially an automated trading contract.
Exactly. Executives set these contracts up a month or even years in advance to sell a predetermined number of shares at a specific time, or maybe when the stock hits a specific price.
Right.
They hand the plan over to a third-party broker who executes the trades automatically. The entire purpose of this mechanism is to allow executives who are, compensated largely in stock to liquidate some of their wealth to buy a house or pay for college,
without facing accusations of insider trading based on unreleased quarterly news. So the sale happens on a schedule, regardless of whether the company just cured cancer or filed for bankruptcy. The executive has no control over the timing once the plan is locked in.
Furthermore, the CEO still retains roughly $20.5 million in beneficial interest in the company.
Oh, wow. So they still have a lot of skin in the game.
A lot. It is absolutely not a full exit. The sources also note that the chief accounting officer sold some shares, but that was explicitly for tax-related purposes.
Likely to cover the taxes owed when restricted stock units vested, right?
Most likely, yeah.
The actual transactions might be routine, but you have to admit, the optics of 12 sells versus 6 buys while the stock is down 48% is just terrible for market sentiment.
It creates a narrative vacuum, that's for sure, and the bears are very happy to fill it.
But honestly, the insider selling is kind of a distraction from the real math problem at the heart of Chewy's stock price.
The valuation disconnect.
Exactly. Even after the stock has declined significantly over the last 5 years, Chewy is still trading at a trailing price to earnings, or PE, ratio of 36.4x.
Right. And to understand why that multiple is problematic, we have to look at the industry average.
Which is what?
The average PE ratio for the specialty retail sector is only 20.9x.
That's a huge gap.
It is. A fair value framework mentioned in the research suggests a reasonable PE for Chewy, given its current state, would be around 24.2x.
So the PE ratio essentially tells you how many years it would take for the company to earn back your initial investment if profits remain flat. Paying 36 times earnings means you are paying a massive premium.
Yep.
It's like paying the sticker price for a high-performance Ferrari, but taking delivery of a very reliable, very slow minivan.
That's hilarious, but totally accurate.
I mean, the vehicle works perfectly fine. It gets you to the grocery store safely, but you vastly overpaid for the performance you're actually getting.
The market is still pricing Chewy as if it is a hypergrowth tech company. But mathematically, a company simply cannot sustain a 36.4x premium valuation multiple when its trailing revenue is only growing at 6.14%.
And its net margins are under 2%.
Exactly. A multiple that high embeds a massive amount of optimism about future margin expansion. When management lowered guidance and explicitly stated consumer spending wasn't accelerating, they directly contradicted the exact optimism holding that multiple up.
Right. So the 48% drop in the stock price isn't the company breaking.
No, it is the valuation multiple violently compressing to match the new reality of slower growth.
So with sentiment in the gutter, analysts cutting targets, and a valuation that still looks arguably inflated compared to its peers, Chewy has to figure out how to dig itself out of this hole.
They do, and they aren't just sitting on their hands hoping the consumer wakes up.
No, the report outlines a very specific recovery scenario strategy.
Management is acutely aware of the corner they were painted into. They know that to justify their valuation and re-accelerate the business, they have to evolve past simply shipping low-margin pet food.
Okay, let's break down the mechanics of this recovery path.
Yeah.
First, they're introducing a $600 million term loan B to the balance sheet. For context for you listening, a term loan B is a type of institutional debt often favored by corporations. It typically has a floating interest rate and requires the company to pay only the interest over the life of the loan.
And then paying back the massive principal amount at the very end of the term.
Exactly. So that's the first move. Second, they are aggressively expanding into veterinary care, aiming to have 60 clinics open by year-end.
That's an ambitious rollout.
Very. This involved acquiring existing companies, specifically mentioning Modern Animal and SmartPak. And third, they're targeting at least $50 million in AI-driven cost savings by next year.
All of these moves represent a significant structural evolution toward becoming a holistic pet healthcare ecosystem.
Okay, I have to push back on this strategy with some serious skepticism regarding the timing here.
Sure, lay it out.
Management explicitly cites a tightening consumer environment and slowing spending. Yet their reaction is to take on $600 million in floating rate institutional debt right now.
It sounds counterintuitive.
And they are using capital to buy businesses like Modern Animal, which the report explicitly notes will be margin diluting during the 2026 integration phase.
Yep.
Taking on debt to buy margin dilutive businesses during a macro slowdown sounds incredibly risky. Why make this aggressive capital-intensive move now when the environment is so punishing?
The reality is they have no other choice.
Really?
If we look back at the structural reality of the Amazon threat we just talked about, Chewy cannot survive in the long term by fighting a price war on basic kibble.
True.
To survive and to drive up that crucial net sales per active customer metric, they must fundamentally change the relationship they have with the pet owner.
Oh, I see. They need to own the entire lifespan of the pet. The food, the medicine, the physical vet visits, the insurance.
Exactly. By moving into healthcare services and vet clinics, they're building a moat with incredibly high barriers to entry. I mean, e-commerce is relatively easy to replicate.
But physical veterinary care is not.
No. Think about the mechanics of customer retention in this new ecosystem. If your dog's prescription history, vaccination records, specific dietary needs, and pet insurance are all seamlessly integrated into one Chewy app.
The switching costs become astronomically high.
Exactly. You aren't going to go through the hassle of transferring medical records and setting up new prescriptions with Amazon just to save a few cents on a bag of food. The friction is too high.
Once they get you into the clinic, they lock you in for life.
Yes. So acquiring clinics like Modern Animal dilutes their profit margins today in 2026 because of the integration costs and the overhead of physical locations.
But it builds a defensive moat that Amazon cannot easily replicate with just a warehouse and a delivery van.
It is short-term pain for long-term survival. The problem is that Wall Street algorithms are notoriously impatient and they do not like short-term pain.
So what are the short-term catalysts that you, as an investor, need to watch for to see if this pivot is actually working?
Well, the most immediate catalyst is the upcoming Q2 fiscal 2026 earnings, expected in late August or early September. We have to remember that management purposely set a very low bar.
Right. They guided for sales of only $3.3 to $3.33 billion and EPS of just 36 cents.
Yeah.
So they intentionally lowered the hurdle so they could easily trip over it and claim a victory.
That is the standard playbook in corporate finance, honestly.
Wow.
If they can post a beat and raise quarter against those lowered expectations, it would force the market to rethink the bearish narrative.
That makes sense.
Given how battered the stock is and how low sentiment has fallen, a solid beat could trigger significant short covering. That's where investors betting against the stock are forced to buy shares to cover their positions, which drives the price up.
But beyond just beating a low revenue target, we need to look under the hood at the customer metrics, don't we?
Definitely.
The net sales per active customer, that NSPAC metric, needs to stabilize. They need to prove that the pullback in discretionary spending has finally found a floor.
Right. And if net customer additions move back toward the upper end of that 150 to 250,000 range, it validates management's claim that this is just a cyclical macroeconomic issue.
And not a permanent structural decline of their platform.
Exactly. We also need to see those $50 million in AI cost savings actually materialize on the balance sheet to offset the revenue softness.
So the path to recovery is plausible, but it is undeniably narrow.
Very narrow. Management has proven they possess strict margin discipline, and that 84.4% recurring autoship revenue provides a genuine, massive floor that prevents the entire company from spiraling into distress.
But the combination of an expensive valuation multiple that is still compressing, a reset in growth expectations, and tough macroeconomic headwinds means a rapid V-shaped recovery is highly unlikely.
Very unlikely, yeah.
Which brings us to the final verdict for you listening. Synthesizing all the data, the shifting consumer metrics, and the strategic risk we've discussed, the equity research report assigns Chewy an overall rating of 4.
Which translates to a cautious neutral stance.
Cautious neutral. That makes sense.
The rating aligns perfectly with the data. The underlying business is fundamentally sound. I mean, it is generating cash, it has a massive recurring revenue base, and it is executing a logical pivot into healthcare.
It is not broken.
It's not broken at all. However, the current valuation simply does not adequately compensate an investor for the execution risk of integrating those vet clinics and the reality of a growth reset.
Right.
Until that PE multiple compresses further into the 20s or the growth trend demonstrably stabilizes and reaccelerates, sitting on the sidelines in a wait-and-see posture is just the most logical move.
To circle back to our opening thought, if you bring home a report card with an A in Q1 earnings, but your teacher knows you are going to struggle heavily with the advanced coursework of macroeconomic pressure, debt integration, and inflated valuation expectations, you don't get the reward.
No, you don't.
The market grades on a curve of the future, not a snapshot of the past. And I want to leave you with a broader, more provocative thought to mull over regarding that future.
Let's hear it.
In modern business, we always talk about sticky subscription models like they are the ultimate holy grail.
Build a subscription, achieve predictable recurring revenue, and you are invincible.
Exactly. But look closely at Chewy. If a beloved company with an astonishing 84% recurring subscription revenue can still lose nearly 50% of its stock value because of macroeconomic headwinds and a slight shift in consumer habits.
What does that mean for the resilience of the entire subscription economy?
Exactly. When the consumer is truly squeezed by inflation, is any subscription actually safe? Or are they all just one bad quarter away from a reality check? Something to explore on your own.
The ultimate test of the subscription model is happening right now across the entire economy.
Thanks for joining us for this deep dive. Keep questioning the numbers, and we'll see you next time.